Hello and welcome to the channel. I'm the Swedish dividend investor, and today I want to talk about the importance of valuation and price. Before we begin, I just want to say this is not financial advice. I'm just a guy on YouTube who wants to help people think differently about investing. Make sure to read the full disclaimer in the description. Today we're going to have a look at a few examples. But I also would like to speak about why I like to do valuation of companies. It makes sense to me. Sure, it's not perfect and it's based on my own estimates, but it gives me a structured process that I can stick to. That's why I won't invest in hype, like Nvidia, or non-productive assets like Bitcoin. I won't invest my money where I can't find value, or where the only way to make the calculations fit is to have out of this world growth in earnings and crazy earnings multiples. You have to put your money where it makes sense. I'm fine getting rich slowly by compounding. My goal today is to help you understand valuation, so you can decide what makes sense for you. Valuating a business can help us determine whether or not said business is fairly priced, under or overvalued. We can lower our risk and maximize our returns. We can also make better informed decisions by comparing where our money will work best for us. There is a lot of ways to skin a cat, and everyone has their preferred way to value stocks. There is the classic PE ratio, price to free cash flow, price to book ratio, dividend discount model, and so on. We are going to focus on discounted cash flow today, and we will get an acceptable buy price by just looking at cash flows. That being said, let's move on to the examples. We have company or bond A, and we have company or bond B. For argument's sake, say we are all knowing and know the cash flows or earnings for 5 years in the future. This is just an example. But we can see the earnings of company A. We have $1 of earnings each year. That sums up to $5. All good. Now we will take a look at company B. They increase their earnings by $1 per year, adding up to $15. At first glance, just with these numbers in mind, what would you invest in? Probably company B, right? Well, what are you willing to pay to get company B's earnings? And between these two companies, are the company A always a worse investment? I will answer the first question later, but to answer the second question, I would say it depends on the price. If the price is the same for both investments, company B is a clear winner. But what if you could buy company A for, let's say, $10? $10 for $1 of earnings each year. That is a 10% return. And if you have to pay, say, $40 for company B, company A is still better. The point I'm trying to make is that price and value matters a lot. For me, valuation is everything in investing. Sure, we have to understand the business we're investing in as well, but overpaying can lead to subpar returns and losses. To quote Warren Buffett, price is what you pay, value is what you get. But real-world investing isn't this simple. Companies just don't generate earnings in a vacuum. Factors like growth rate, interest rate, and inflation all play a role. That's why we also have to factor in an essential principle: the time value of money. Let's take a look at an example. Company A costs $10 and they promise to pay you $5 after the first year, then nothing until the end of year 5, where your principal, the $10, are returned. An identical company for the same price, company B, they say they will pay you back $5 as well, but you will get the $5 at the end of year 5, where you also get your principal back. With that in mind, company A is the better alternative, since you get your return after just a year and those earnings can be invested in something else. Again, not a probable investment scenario. Let's put that into practice. In this example, we use something called the discount rate. This represents the opportunity cost, what you could earn elsewhere. I personally like to use it as my expected return. There is a lot of alternatives what percentage to use, but we will stick to the 10%. We can see the formula to the right, so the future value equals present value multiplied by 1 plus the interest rate per period raised to the power of the number of periods times the number of years. I know, it sounds complicated, but it's just math, and I'm sure it will stick in the future if you practice this. Instead of interest rate, we will use the discount rate, as mentioned before. When we use the discount rate and discount the $5 from year 1 from company A, we can see the $5 is worth $4.55 after a year. That's the future value as shown below. When we look at company B, we will see a different number. Why? Because it compounds. The more the time passes, the less it would be worth today. The nominal return is the same, 50%, but the time value of money adjusted return is very different. Let's call it real return. Now that we understand the time value of money and how it impacts our investments, the next step is using it to determine a company's true worth. This is where discounted cash flow, DCF, analysis comes in. The gold standard for valuation. Let's break it down. This part will add a bit of complexity to the calculation. Now, keep in mind, this can take a while to understand. It took me a long time to understand it, and it's okay to get lost. Instead of just discounting one cash flow, we're going to apply this concept to an entire business over 5 years. This is where discounted cash flow analysis comes in. It's a powerful method that helps us estimate the intrinsic value of a company by discounting its future cash flows back to today. DCF isn't just theoretical. Investors use it to determine if a stock is over or underpriced, helping them avoid bad investments. Let's apply this method to our two companies, A and B, using a discount rate of 10%. We will calculate their intrinsic value based purely on their earnings or cash flows. By the end, we'll know exactly what price we should be willing to pay for each investment to achieve our target return. So I can answer the question, what are you willing to pay for company B's earnings? As we can see on the formula on the right, discounted cash flow equals the projected cash flow for each year divided by 1 plus the discount rate to the power of years forward. To account for earnings beyond the forecast period, we calculate something called terminal value. This estimates the company's value at the end of our projection period. We use the formula terminal value equals the final year earnings or cash flows, marked in purple, times 1 plus perpetuity growth rate divided by discount rate minus growth rate. For company A, since there's no growth rate, we can use a simpler formula. Cash flow year 5 divided by the discount rate, and that gives us a terminal value of $10. Now we discount that using the formula terminal value divided by the discount rate raised to the power of years. In this example, 5 years, and we get $6.21. Add the terminal value and we get an intrinsic value of $16.21. Don't worry if this looks complicated at first. It will get easier with practice. To determine the price we should pay today, we discount the intrinsic value back to the present. This means taking the intrinsic value and dividing it by 1 plus discount rate raised to the power of the numbers of years. For company A, this means taking $16.21 and discounting it back 5 years, giving us a fair price of about $10.06. As you can see, we figured out, just based on the cash flow, the price we need to pay to make a 10% return, and this is the kicker. There's no price for the business in this example. In the early examples, we had the price, and company A was a pretty no-brainer 10% return, since $1 is 10% of $10. Now for company B, it's all the same calculation. And I have to note here, the $5 at year 5 stays at $5 in perpetuity. To answer the question, what are you willing to pay for company B's earnings? We get a terminal value of $50, discounted terminal value of $31.05. Adding those up to get the intrinsic value and discounting it back to present time, we get a present value of $50.32. There are some more decimals here, but we round up. And here is the forward calculation on a calculator. So not exactly correct, since we didn't type in an infinite number of decimals. That's a basic crash course, assuming we had perfect knowledge about future cash flows. But in real life, investing isn't that simple. Companies don't have fixed earnings, and we have to make educated and conservative guesses about growth rate, economic conditions, and investor sentiment. For example, if you were valuing a company like Apple, you had to consider things like future iPhone sales, service revenue, and competition. That's why valuation is part science, part art, because we're making informed estimates rather than working with perfect information. DCF is just one way to estimate intrinsic value, but there are many others. One of my favorite approaches is using a terminal multiple instead of perpetuity growth model. This method assumes that investor will value a company's cash flow at a certain multiple in the future. Let's take a look how that works. This is a very simplified model, where instead of calculating the terminal value using the discount rate, we simply use a multiplier for the final year of the cash flows, and where we calculate the discounted terminal value the same way, but the difference here is to get the present value, we add up the discounted cash flow and add that to the discounted terminal value. That gives us exactly $10. Very similar, but as the model shows, company B now has a present value of $41.70 instead of the other models $52.32. This is why it's both science and art. We can complicate even more. Here is a preview of the one I use, using different growth rates during a 10-year span. But that is a story for another time, since it's a much more complicated model. So, what did we learn today? Investing is not just about following hype, it's about finding real value in companies. $1 today is worth more than $1 in the future because it can be invested and grown. DCFs helps us estimate a company's intrinsic value by discounting the future cash flows back to today, using a discount rate of our required return, and help us figure out the maximum price we should pay to meet our return goals. Valuation isn't perfect, it's based on assumptions about growth, and there are a lot of valuation models. Valuation is both a science and art. While we can't predict the future perfectly, using these principles helps us make informed decisions and avoid overpaying for stocks. Have you tried valuing a company, and what method is your go-to? Let me know in the comments. I would also suggest you try to build a simple model yourself. Learn by doing. A great source for the terminologies and formulas with explanations are investopedia.com. Alright, if you enjoyed this video, remember to hit that like button, comment and consider subscribing. It would mean the world to me. I'm the Swedish dividend investor, and I will see you in the next one. Ha det gött!